Welcome, everyone, to the latest in Eide Bailey's series of presentations with respect to the progress of the Build Back Better legislation. Lovely pictures of Jay and myself. Remember, if you want to contact either of us, it's the first initial of the first name and last name, no dot between, at eidebailey.com. So I'm M. Schwarz at eidebailey.com. Jay is J, just the letter Heflin, at eidebailey.com. And we're always happy to hear from you. Always happy to answer any specific questions that you may have regarding either what we say today or other things that may be of concern to you with regard to the legislative process. Neither Jay nor I are licensed or approved to give any financial accounting advice. So if you want to send those questions, we'd be happy to forward them to someone else. The focus, I think, of today's presentation is going to be on where things stand, because we do have the infrastructure bill signed into law. That's a $1.2 trillion piece of legislation. It's something that we now at least need to be aware of, and is going to have some tax effects on some fairly specific situations. The larger piece of legislation, the larger piece that involves taxes, is of course what's now going through Congress as the reconciliation bill. And the House has approved its version, and we're going to talk about provisions in the House bill today, because that is really, for better or for worse, likely to be the starting point for whatever happens in the United States Senate. However, they are now just beginning to try and come to some conclusions in the Senate. And so consequently, there is still a great deal of uncertainty as to what provisions are going to survive, what provisions may be changed, what provisions may be added in that could have been talked about before, but were not necessarily included in the House bill. And Jay and I are going to try and get to at least some of the major ones that we know are under discussion. But keep in mind that phrase, under discussion, is very important here, because we do not know exactly where this Senate legislation is going to come out. We do not know exactly what's going to happen when it goes back to the House. Now, the very last item here on our slide, the deadline for the Senate to pass the bill is Christmas. Well, that is certainly what Majority Leader Schumer has said. That is his goal, is to pass the bill through the Senate by Christmas. What that does for the House of Representatives, who will then be faced with, do they come back between Christmas and New Year's? Does this carry over? The use of the term deadline in Congress has a fairly flexible meaning, and I would not. Well, anyway, what date you choose to pull in the passage lottery, I think is up to you. Now, as I said, we do have the infrastructure bill enacted. The president has signed it. Mostly it's a spending bill. There are a few tax items that are worth noting. If you have connections in the chemical industry, certainly chemicals that are derived from petroleum, the Superfund tax is back. It is back at different rates than the old Superfund was, and you need to take a look at that. The cryptocurrency, we do have new reporting requirements with regard to cryptocurrency. We may see some changes in that as it goes through. We may see some changes that the Senate is going to consider that could affect that. But at least for the time being, reporting requirements are in place. A necessity of treating crypto exchanges in crypto under the brokerage rules are in place. If you have not necessarily crypto that you own personally, but if you are in a banking situation, if you're in a brokerage situation, certainly you need to be paying attention to those. Key item is the very popular employee retention credit. that was originally scheduled to run through the end of the year was cut off as of September 30, 2021. And we now have some specific guidance. This came out this week from the Internal Revenue Service as to what you do if perchance you had already affected any of your fourth quarter filings to reflect what you thought was going to be an available ERC that it now turns out is not available. Because remember, the House did not pass the legislation until we were already in the fourth quarter. Essentially, what the IRS has said is, okay, we're going to waive the penalty. We're going to waive any underpayment penalty. We're going to, for the failure to make it. But you need to catch up, and you need to catch up primarily with the filings for your fourth quarter of 2021. So the last filing for the fourth quarter of 2021 is going to be the end of the period that you have to get right with this. That's not a lot of time. I think most of us had hoped that we would get a little more in the way of a period to deal with this. But this is what has come out of the Internal Revenue Service. I don't think it would be possible really to challenge this at this point. So I think that simply something that as a compliance matter needs to get on the calendar. And we need to note the December 2021 date, no more bad filings, or no more filings that include the fourth quarter ERC after 12/20, and catching up with the filings on that last fourth quarter filing. Now, if you have one of the new startup businesses that were accepted and that were allowed to go through the recovery startup businesses that were allowed to continue in the fourth quarter, then the expectation is that you will take your credit through the fourth quarter, will not take any credits after that. And so there was no need to specifically address the situation for those types of businesses. Now, I mentioned earlier some concerns with regard to crypto. The crypto rules applied and required reporting by anyone who essentially facilitated the crypto exchange. Okay, well, what does facilitated mean? There is concern that somebody who writes code that writes blockchain code that allows the crypto to work through could be swept in by that kind of provision. Senate Finance Chairman Ron Wyden has been an outspoken critic in his concern for this. We do not know whether this could get slipped into the reconciliation bill. It may have to be addressed as a separate piece of legislation going forward. But there does seem to be general support for at least excluding those who develop blockchain technology and making it clear that that is not intended to be swept up. Could the service do this by themselves? Yes, they probably could. The question is, would they? And that is a very open question. So at least for the time being, we expect Senator Wyden to continue to push forward with this concern. Which brings us to the slow progress of the tax and spending reconciliation bill. And to discuss where we are with that, I'm going to turn things over to Jay. Jay, have at it.
Thanks, Mel. So here we are on this slide, and the progress has been slow, but that's not unusual for Congress. If you remember Obamacare at all, it basically lasted a year. So we are in the process of like 10 months into this. So this is not unusual. The thing that you might notice is that things might start really speeding up here toward the end of the year. And the reason why I say that is that I have spoken to a few reporters who have been reporting that this bill is going to go into 2022, and they're now not so sure about that. And I'll explain that later as to why they think that. So first of all, as this is one of the reasons why they thought that the bill wouldn't be passed until 2022. Congress has a bunch of must-dos, and they're all really no big deal, but lately they've been very big deals. And one thing that they had to do was fund the federal government, and that was supposed to be a huge fight. On December 3rd was when funding ran out, and they passed it with hardly any sort of upheaval. But they've also made themselves another deadline, which is mid-February of next year. They're going to have to find more funding for the federal government. And the calendar year for, or the fiscal year for the government is December 30th is when the current year ends. They're probably not going to get any sort of agreement to fund the government for the whole fiscal year. So we're going to see maybe a couple more deadlines before they actually get through the fiscal year. And then there's always the internal hope that appropriations will be made and they will get an agreement and they can fund it for the rest of the year. But currently it looks like they're going to be basically facing a funding bottleneck for at least a couple times for the rest of the year. Now, beyond that, Congress also had to deal with the National Defense Bill and the debt limit. Now, these also were supposed to be hairy experiences. And the National Defense Bill kind of was, but not to the point that people thought. If you don't know what the NDAA is, it is a spending bill that gives money for all kinds of defense things. And this also includes Space Force, which is a new thing that we have, where we have now an army in space trying to protect us from way, way up to make sure nothing gets us from on high. That a lot of those issues that were there were kind of fuzzy. Republicans wanted to say, I want more time to debate the bill. I want more amendments on the bill. And so Schumer just basically said, okay. And they did it, and it got through. As for the debt limit, they created a new law that surprisingly Senator McConnell did. Now, Senator McConnell is the Republican leader. He's the minority leader in the Senate. And he said, look, Republicans aren't going to vote to increase the debt limit. We're just not going to do it for political reasons. And so he created a law where basically the term reconciliation is used a lot, and that's a budget procedure. But the big thing about reconciliation is that it takes a simple majority to pass the Senate, but it has all these other rules. Well, McConnell, and with work from Schumer too, they basically made a reconciliation bill that took away all the bad stuff and just allowed the debt limit to pass with 51 votes in the Senate. And there is no actual debt limit increase in that bill. And so that bill will come later, probably Monday in the Senate and Tuesday in the House, where what was passed in the Senate and House this week was, we approve of you using this new law to pass an increase in the debt limit by a simple majority in both chambers. That's basically what the law is now. And it's one time only. This does not apply to anything else ever again. I'll be curious if that actually happens. But now what happens is, since they have a simple majority that needs to pass it, now Democrats can increase the debt limit to whatever they want. Chances are it's going to be after the 2022 election. So they might add 2 or 3 trillion to the debt limit, which puts it in the lower $30 trillion area. And both chambers can pass it, and then Biden will sign it into law. And then supposedly we'll never see this sort of shenanigans again. Well, I don't think that's going to happen. We're going to have another landlocked situation where they need to deal with something, and they're going to figure, hey, we did this. This creates precedent for doing this again and again and again. Now, some of the Democrats are cheering, saying, hey, this is the end of the filibuster. This is the beginning of the end of the filibuster. Republicans are saying, no, it's not. And one reason for that is that even though it only takes 51 votes to pass, it took a procedural vote requiring 60 votes to allow the 51 votes to happen. So in some cases, there's a saying in DC that sometimes it takes 60 to get to 50. And that's exactly what happened here. So when you read that this new bill eliminates the filibuster, it really didn't, because what the term is cloture, and cloture takes 60 votes, and that is a way of saying it's been filibustered. So whatever happens here down the road is unclear, but chances are when they get into a hot spot, this situation is going to come up again. So anyway, let's talk about the rumor mill that is constantly churning out everything. Like we've said, Christmas is the new deadline because of the NDA and debt limit. Well, those are gone now. And so that's why things are starting to kind of shift with reporting and even the attitude of staffers on how quickly this will go. Now, the new deadline, it says the State of the Union, which was originally supposed to be there. That was things are changing a lot over the time. That was because there was a rumor that the child tax credit would be extended as a standalone bill. That no longer seems to be the case. The Ways and Means Committee has said, we are not working on a standalone bill for the child tax credit. So then the question becomes, oh, well then this must pass this year because the child tax credit. And they're like saying, well, maybe not, but we have until January 15th to actually do something on reconciliation for the child tax credit. So who knows what's going to happen there. But one thing that is bubbling up is that a lot of the changes that the Senate wants to make may not fit what House Democrats want. And it's because they want to basically make sure that the wealthy are taxed as much as possible and everybody else doesn't get taxed. And the reason for that is because of the last bullet here, election year jitters. The House is assumed to go Republican next year after the 2022 election. So in 2023, you might have a House majority. The Senate is questionable right now, and they might become a Republican majority after 2023 or after 2022 elections, which means 2023, you could have a Republican Congress and a Democrat in the White House. What's interesting about that is the turn of tax provisions will change dramatically if that occurs. It'll be toward renewing the individual tax cuts that expire under the 2017 tax reform bill. And a lot of work might be used for that because those end in 2025. So basically at that point, you have 2 years to renew those things. Now, you might say, well, it's not going to happen because Biden's in the White House and he's a Democrat and he has said these tax breaks shouldn't happen. Well, Obama said that in 2010 or said that in 2008 in the run up to his election. And then he ran on the fact that we're not going to renew the Bush tax cuts. In 2010, he renewed all of them for 2 years. So there might be a lot of changes that happen with what's going through tax legislation through the Senate and House if things change. And so that's just kind of a wait and see situation. But meanwhile, while we are here on the reconciliation bill, no Republican is expected to support this bill at all. So what that means is that the margins are very, very tight. In the House, they can lose 4 Democrat votes and it fails. In the Senate, they can only lose 1 and it fails. These are extremely tight margins. And so that's why they're really trying to do everything that they possibly can to make sure that everybody's on board with this because they need everybody. That's why you hear the word mansion and cinema forever, because these guys are really saying, they're basically saying, I don't like the bill, but they can't say that because if they say that, then they can't vote for it, and that would be a problem for Democrats. But so the House passed a bill and it was brought over to the Senate. And basically what's going on now, and we're going to see this slide a few times, so I'm only going to talk about what is being bolded, and that is the state cap deduction, or the salt cap deduction, I'm sorry. This is probably the most controversial thing in the entire bill. And the reason for that is because what the House passed is an 80% cap instead of a 10% cap. They didn't have an income limit on who could actually do it. And so what they're trying to do now in the Senate is to make sure that that people under a certain income, and that's up in the air right now, can actually have an unlimited cap. The people over a certain amount of income will have to have the $10,000 cap. And so right now it looks like the salt cap, which was set to expire in 2026, or actually the end of 2025, that might continue on for quite a while now. So Mel, you're back on. Is it your turn to take, or do I keep going?
No, I will take over from here, because we've got some other things to talk about. I think it is important, though, Jay, to point out where we are with respect to the debate here. Whether Bernie Sanders, who has proposed essentially cutting off the or retaining the $10,000 cap for taxable incomes of $400,000 or above, Senator Menendez, who seems to be representing the group that was successful over on the House side in getting the rule that we see, the increased deduction, 80,000, is pushing for a higher number than that. There are some rumors that the $80,000 cap in the House was based on a calculation that was done with respect to New Jersey taxpayers. Whether that is true or not, we don't know, but you always get those sorts of rumors. I think, Jay, what is your feeling? Are we going to ultimately see some sort of resolution here, or is this something that could crash the entire bill?
Well, it could crash the bill, but what's going on right now is that you have House Democrats that support removing the salt cap entirely, threatening to oppose the bill if the salt cap is not modified in the bill. The reason why they're doing that is because in the Senate, there are a lot of Senate Democrats who don't support uncapping the salt deduction. And so they want to keep it at $10,000, and they like that because it goes to like wealthier people. Well, what's going on now is you have House Democrats threatening Senate Republicans from offering an amendment during vote-a-rama of reconciliation to repeal any modification to the cap, because Senate Democrats might just support that bill. Because basically what happens, and again, it goes back to the election, the Senate Republicans say, hey, the $80,000 cap, we're going to repeal that. It goes back to $10,000 for everybody. And then a Democrat who's facing re-election and in a tight race might say, oh, I'll support that, or no, I will not support that. And then suddenly political ads come up. This person was in favor of giving the rich a wealthy tax break. And it just keeps going on from there. So
enough, too much. A little chess game that seems to have less to do with policy than it does with the 2022 election. Unfortunately, I think that probably is a way to view most of what is going on Capitol Hill right now. Is not necessarily are they finding the correct tax policy, but rather are they preparing for the election in 2022, and again then in 2024. Let's go on and talk about some of the other provisions that we see in the House reconciliation bill, which again, as Jay's pointed out, not all of these are going to make it. Many of these may be modified, but they are at least a starting point. Two that have received some significant opposition, some significant discussion, are the essentially what's now being called the millionaire surtax, the 5% surcharge on modified adjusted gross incomes over $10 million, and then kicked up to 8% if your modified adjusted gross income goes over $25 million. And probably even more controversial than that is the idea of a 15% minimum tax on financial statement income of corporations that have over $1 billion in profits. Now, both of these provisions are really replacements for what the House originally thought they were going to do with respect to tax rates. They were looking at going back to 39.6% on the individual side. They were looking at going at probably somewhere in the neighborhood of 28% on the corporate side, and that was going to raise a significant amount of revenue. And when those fell by the wayside, then these were taken as replacements. Now, there is some significant money in both of these provisions. The millionaire surcharge is scored to raise $228 billion over 10 years by the Joint Committee on Taxation, and the minimum tax is scheduled to raise $319 billion. Well, if, as we are now hearing, there is controversy, there is some opposition to including these, how are you going to replace that money? Are you going to come back to rates? The reason that the House moved away from the rates was it was made very clear by Senator Sinema from Arizona that she was going to oppose legislation that included those tax rates. Now, there is some thought that the book minimum tax in particular is a bad enough idea that just may have to be replaced, and that they cannot live without that $300 billion over 10 years in order to try and keep the books at least close to balanced. And so we might see a turn back to an increase in the corporate rate. Now, that is not going to go all the way to 28. Discussion of going above, there is no discussion apparently of going above a 25% rate. And depending upon how the revenue estimates come out, I think you might see even a smaller number than 25%. If the book minimum tax goes away, is dropped out of this provision, there's going to be a strong push to include at least some increase in the corporate tax rate in the final legislation. Now, what the rate will be, other than to say 25% would be an absolute maximum. Other than that, we don't really know what the rate might be. We don't know what the trigger might be. It may be that we'll see a rate that's close to 25%, but only is applicable to very large corporations or extremely profitable corporations. And we retain the 21% with regard to most of corporate America. Whether we could then build in, because of course the House also included a step rate that had a lower corporate rate for very small corporations. Can that come back as part of this? You know, again, we do not know. We do know that Ways and Means Chairman over on the House side, Richie Neal, wanted rate increases to be in the bill. He was willing to see them taken out and replaced with the millionaire surtax, replaced with the book tax, minimum tax. But I don't believe we can say that really changed his attitude with respect to them. So I think you were not going to see, if something can be worked out on the Senate side, particularly with respect to a smaller corporate rate increase in exchange for dropping the book minimum tax, that is something that is very, very much potentially on the table. Another provision that's included in the House reconciliation bill that has some controversy right now is the changes on the international side, particularly the country by country computation for the GILTI rate as well as the foreign tax credit calculation. Now, there is some opposition to this provision in general. However, a lot of what we're seeing as opposition and concern reflects not with the provision itself, but when the provision becomes effective. Now, the 15% is keyed to the amount that was agreed by the OECD countries as what should be a worldwide minimum tax. Now, the fact that OECD has agreed to that as a worldwide minimum tax rate is not the same thing as an OECD country implementing legislation that makes that the case. And there are a number of senators, including a number of Democratic senators, who would prefer to wait and see some other countries, particularly countries that have traditionally relied on low rates, such as Ireland, want to see them adopt legislation before we adopt our legislation that builds in this 15%. Now, the administration, who has wanted to be seen as taking the lead in this debate, very much would like for the United States to go first. So we're going to see a tension there. But that, I think, is more than a question of what is, whether this is something that ultimately is going to happen. Right now, the status seems to be this is a discussion of when it is going to happen. And is the administration going to be able to push this through? Or rather, are we likely to see a deferred effective date? Already, we see deferral of by a year of the implementation of this. We might well see deferral of a number of years and possibly even a trigger, which requires certain actions to happen overseas in OECD countries before this triggers in. Let me step back just 1 minute with regard to slides. A couple of other items that are here. The application of the 3.8 net investment income tax to the active trader business income of a partnership or an S corporation. This one is again, this is about a $250 billion revenue raiser. All indications are that this one is likely to stay in place. Now, there are some real questions as to what's going to happen with regard to the pass-through deduction 199 cap A itself. But this seems to be an item that there is general acceptance with respect to. Also, the 1% surcharge on corporate stock buybacks. There is controversy here. Again, this is part of the replacement for a corporate tax increase. And again, the fate of that particular provision may in part depend upon where we end up with respect to the corporate tax rates. Now, some other, one last item of important to consider. Particularly because it got scored by the Joint Committee at $1.4 trillion, is increased IRS spending, increased IRS enforcement. The Congressional Budget Office is not giving this kind of credit to the bill, and so consequently, the CBO numbers that are coming out now are showing the legislation as a significant revenue loser. If you push everything out to 10 years, which is the normal budget cycle, then the amount of revenue loss goes as high as $3 trillion with the IRS effects not being included. Where that is likely to go, where the IRS spending issue is likely to go, very much up in the air. I would suspect that something is going to stay in. And the Democrats are simply going to have to argue that, well, whether the CBO gives us credit for it or not, we should be given credit for it, which is a great tradition in both parties to claim credits that are not necessarily there. And I seem to be going the wrong direction here. Well, and here's the statement with respect to that. There is some idea of saying that, well, we'll give the IRS the money, but they can't use it to audit people who earn less than $400,000. Because after all, the president promised that we were not going to increase taxes on anybody earning less than $400,000. Now, whether having the IRS come look at your tax return constitutes increasing your taxes or not, that is something that we will leave for discussion in Logic 302. And please let me know if you come to any conclusions. Important to note a few other items that are included in the reconciliation bill. Each of these has some level of controversy, perhaps not the amount of attention that we have seen with regard to the others. I think everybody is pretty much in favor of delaying the requirement to amortize R&D expenses. So I would not expect that one to fall out of the legislation. There's also a provision to make effectively to make refundable more of the research credit, so to be allowed to be taken against the payroll tax for small businesses. Since we're no longer going to have the ERC, we're no longer going to have the family first paid leave provisions, the payroll taxes is likely to come back as more of a significant revenue item and give us a place to park that particular benefit. The energy tax incentives, right now we're looking at, excuse my check here, we're looking at a significant amount of money with respect to those, about $311 billion over 10 years. There is some thought that some of these may be ill-considered. Some of these may be inappropriate in that they have a built-in reward of Democratic friends. Particularly noteworthy there are rules that provide a higher credit if you purchase a car that is built with electric car that is built with the union labor, or you build a plant that is associated with green energy product that itself is built with, doesn't say union labor, but it says you have to pay prevailing rates, prevailing rates, and you have to use a certain number of apprentices. Well, where's the easiest place to find an apprentice? Probably your local union, or alternatively, your local community college. So again, some question as to whether those sorts of rewards should be considered. I would expect that we will see renewable energy tax incentives continued, but I think we're likely to see some changes in the details. And Jay and I will be back on the air with a program later in the year that will talk specifically about where those go. You can see some of the other items here. Excise tax on e-cigarettes is also become controversial, again, because of the $400,000 promise. And certainly there are people who earn less than $400,000 who use e-cigarettes. Let's go back. What is not in the House reconciliation bill? Well, most importantly were the rates. And we talked about what were put in as substitute for the rates, what possibly could come back in the way of a rate change if we were to move away from the substitutes that were used. Notably, items that primarily affected the estate, gift, and generation skipping tax exemptions. Were not included in the House bill. We're not hearing the same level of discussion about them being restored in the Senate bill. Similarly, well, there are discussions about modifications to the pass-through deduction, as well as bank reporting. Now, bank reporting, which was very controversial when it came out, was originally intended in the House to be an offset for whatever they did with regard to state and local taxes, the deductibility thereof. It was dropped before the final version. While there are some members in the Senate that would like to see it restored, I think that is likely to be something of an uphill battle. Now, the pass-through deduction has specifically been addressed by Finance Committee Chairman Wyden, that he would phase out the deduction for incomes over $400,000, so that it would be completely gone above $500,000. Would do away with the limitation for, or the current rules with regard to professional service firms, but obviously then would be subject to the new cap. Not at all clear this is going to be added to the Senate bill. It does seem to be a particular concern of Senator Wyden, but as has been noted, this legislation is reported out of the Budget Committee. It is not reported out of the Finance Committee. Beyond that, it's not at all clear whether this is the kind of change that would be acceptable over on the House side.
Yeah, Mel, can
yeah,
I
please do.
The big thing, if you open it up to law firms and accounting firms, House Democrats are going to go for that. That's just their thing. They just think, why? You guys are rich already, literally.
Yeah. You know, although the part of the problem there is because if you're also going to limit it to 400,000, I mean, you're really talking about a fairly narrow window that you're opening there, because attorneys and accountants, who which this seems to be the focus on, are eligible to claim this up to an AGI of around 300,000. So you're really only, if you build in this $400,000 limitation, you're really you're not opening up that broad an opportunity, and certainly not opening up an opportunity for a white shoe Wall Street law firm to take advantage of that, assuming again that well, assuming what we know about the structure of white shoe Wall Street law firms. But as you say, it is one that it does create a situation where the politics and the visuals are not necessarily good, and the House has taken enough heat from the SALT provision with respect to that not looking good, with respect to providing too much benefit for rich people, that this is something that they simply may not be willing to go with that particular kind of change. As I say, the bank reporting provision, it circulates around, but again, there were good reasons why this was dropped over on the House side. And there are probably some very good reasons that it may not gain that much in the way of traction on the Senate side. This is also one of those items that is dependent upon, its revenue score is dependent upon increased compliance. And if CBO is not going to give credit for funding the IRS, there's some question as to how much credit CBO is going to allow for a provision like this. And if CBO won't score it, why bother to add it? Now, that gives us, I think, just a quick rundown of some of the key items, but that's not the only, tax is not the only thing that's going on here. And I'm going to turn things back to Jay to talk about some of the other provisions in reconciliation that, although they may not affect our ability to fill out tax forms, certainly are going to have a very significant effect on the ability of this legislation to move forward. So Jay, your turn.
All right, thanks, Mel. So child tax credit. This is a really big deal in Congress because it goes to so many people currently right now, and they want to keep that money going. This ends on the 15th. The final payments are, unless we extend it. The issue here is that Manchin wants some sort of work requirement for this, and House Democrats are just not going to go for that. They just won't, because the argument that they have is these people quit their jobs to keep their kids safe. So now you're going to have a work requirement that they depend on because the child tax credit gives them money that they need. And you now want them to go back to work and they're afraid that their kids are going to be infected. It's just not going to fly. And so if Manchin, who has 11 million reasons to oppose this bill, this is one of them, but it could be the biggest one that could really kill it in the House if the Senate abides by this. It's unclear, obviously, like everything in this bill that's going to happen, but a lot of Democrats are going to be raging about this in the House if a work requirement is added to the child tax credit. So here are some other tax issues that we've mentioned that are problematic. The union shop tax credit, if you buy a car or truck from a shop that is union, or that the manufacturer is a union shop and you bought it, you get more of a credit than if you didn't, is really not going well with a lot of Democrats that don't have union shops. And so currently some Democrats tried to basically debate against this provision, and that debate was lost. So this provision is still currently in the bill, but I don't know how long it's going to be in the bill because one reason is that they might need the money to offset other things, and this is on the lower end of need, especially during a pandemic. What about a union shop? Makes this about something about building back better. Shouldn't we all have the same thing to build back better and not just those guys? Because that's kind of you're choosing winners and losers there, to be honest. And that's something Democrats have always railed against. And so I'm really kind of curious if this is going to happen or not. Same thing with the above the line deduction for employee uniforms. I worked at a place and it was a union shop and I was non-union. I was one of the guys that it was loading trucks. I had to load the trucks when the other guys were on break. And I wasn't able to take anything off of my deductions for anything. So that could be a problem as well. Again, it's a lower tier thing of what does this have to do about building back better from the pandemic? Why can't we all take a deduction is the thing. The tax on e-cigarettes is rumored to already be out. I forget how much money is raised with that, but that, again, you're going to tax e-cigarettes again. How does that help with the pandemic? And these questions are actually happening. Like, what exactly does this do with building back better from a pandemic? And so I continue to say that because this question is being asked on Capitol Hill and it's not getting answered. And that's a problem. So again, the climate change, there's a lot of fees and a lot of possibly a fossil fuel tax could be coming back into the bill, but we just have to wait to see what happens there. So we talk about tax increases, but there are so many other issues in this bill that people just that are not politically soothing, to point a phrase. The paid family leave is very much a part of building back better from the pandemic, but it's run into troubles because Senator Manchin has said, what does this have to do with, getting there? Well, it's actually really kind of fits with what we're trying to do here. There is paid family leave so people can take off work and be with their kids or be with elders and all that, but he doesn't like it. And he basically has always said, what does this have to do with the pandemic? Well, that actually hits the pretty close to what you have to do with the pandemic. So I don't know exactly what's going to happen there, but if they do change it, if they do shrink it in any sort of coverage, that will get major blowback from the House whenever it goes back there. Here's an issue that is really big, but not been talked about enough because the focus has been on what provisions in, what provisions out, what this. So the Congressional Budget Office said that this bill will add $367 billion to the deficit for the next 10 years. Well, Democrats said, no, you're not adding everything. And what Mel talked about with the IRS funding, that's correct. Like what they do with increased enforcement isn't a part of the revenue score for this bill. But if you add in that revenue score that's not official, you still increase the deficit by $160 billion a year. Well, the CBO just came out this morning, literally 5 minutes before this program started, saying that the deficit would be increased by $3 trillion over the next 10 years if every spending tax cut provision in the bill was extended for 10 years, because some of these don't last the full 10 years. And it's the Republicans in Congress asked the CBO, the Congressional Budget Office, to do this because they knew the answer. It's going to be a huge hit on the deficit. The thing that's funny about this is both parties do this. They always do things to where, oh, we'll start this later in the 10-year window. Oh, we'll start this earlier and end it earlier in the 10-year window. So this is something that both parties do, but there are members who are in really dicey situations to be reelected that have said, I will not vote for this bill if it adds to the deficit. And so at face value, you can say the CBO, that's the bookkeeper of Congress, says this adds to the deficit. And they will be asked, how did you support this? And in Washington, if you're explaining, you're losing. And if they have to say, oh yes, the CBO said this, but it didn't really mean that because of IRS, because of this, because of that. And if you do all these other things, then yes, it doesn't add to the deficit. But once again, people tune out to that. This is so quick. And Republicans now have done something that said, it's not 367 billion, it's 3 trillion. So this is a messaging war that's going to happen. And I don't know how it's going to end, but if some of the Democrats who are facing tough re-elections, especially in the House, go, wow, I can't do this because of the deficit, this bill may not pass. So like we said before, this is all in the Senate. And so changes are going to be done here. And let me just move on. So like we said before, the NDA and the debt limit, they have been addressed. And when this slide was done, they actually weren't addressed. Now, the second bullet here, the bird bath must be completed. The bird bath is Senator Robert Byrd back in the 80s was the appropriations chairman in the Senate. And he was like, every time we use the reconciliation bill, it's used for things that don't really affect the budget. And this is a budget reconciliation tool. This is how we reduce the deficit, but we're using it for way too many things. So he created all of these rules that a provision has to meet to be in a reconciliation package. So it's called a bird bath, where every provision is scrubbed, i.e. cleaned, and it has to meet all those things. If they don't meet those things, it's called a bird dropping, which means it's dropped out of the bill. So this is going on right now. And next week, the Republicans in the Senate will start debating what they think needs to be a part of the bird bath. And what that means is Republicans are going to say, I don't think this belongs in the bill because it doesn't belong in a budget reconciliation bill. So I think it should be out. Mrs. Parliamentarian, what do you think? And then she will come back and say yes or no or whatever. Now, we don't know really how long this is going to take, but Senator Schumer wants to start this bill next week, the debate on the floor. If he does that, what we have is called a vote-a-rama. Now, the reconciliation bill hasn't gone through any committee in the Senate because of power sharing rules, and that's a really long story. But basically it means because the Senate is 50-50 split, nothing can pass out of the committee and go to another committee. So therefore, we're just going to ignore all the committees and just take it from the Senate Budget Committee straight to the floor, which the power sharing rules say can happen. So when it gets to the floor, there's a thing called the vote-a-rama. And since no bill has been through a committee, it means almost every provision you ever want in the bill or ever want could be raised as an amendment to this bill and be voted on. And vote-a-rama is where you're going to see most of the Republicans in the Senate try to knock down whatever SALT amendment or whatever SALT provision is in the bill. This is where they're going to try to knock it down. And you're probably going to see dozens of amendments toward the SALT provision to try to kill it in every way that they can. Now, because of the bill and the CBO currently shows that it's a deficit producing bill, the bill is likely to shrink. And according to some of the staffers that I've spoken to, the thought is that you're going to reduce it on the spending side and not increase it on the tax increase side. So it's really kind of funny because I was like, okay, so what happens if the book tax is out and you bring in a corporate rate increase? Why don't you just cut spending? And they were like, oh, well, we can't do it that much. Well, then how much do you do? So this whole idea that spending cuts are going to rival tax increases is kind of a misnomer because you guys are going to do whatever works. The big issue is what can get through with every Democrat supporting it, i.e. Manchin and Sinema. And that's probably the biggest issue with going with spending cuts rather than going with tax increases to make sure that the bill does not increase the budget. Anyway, it says bottom line here, Christmas is going to be hard. It might be, but looking more likely that they could do it this year than it was a week ago. So I'll go very quickly with this stuff because we're almost out of time. The House has to accept this bill, and many times what they do is just accept whatever the Senate did, and the House hates that. And so there is a mantra in the House that the other party is the opposition, but the Senate is the enemy. That's because they have forever had to accept what the Senate did and then just move on. Well, they're going to do the same thing here because the Senate is going to take it up to the end of the year. Then they're going to hand it over to the House and say, oh, you've got like 3 days to do this. So good luck with that, because effective dates are January 1 for several provisions. And so it'll be interesting to see what they actually do there. But the House is not happy with how the timing is working for this. And let me see if I do this. So this is Manchin. Bottom line, he has forever said he's kind of against this bill. It'll be interesting to see if he actually votes for this bill. He has lost all credibility with a lot of people. The other person, Senator Sinema, she has basically said we shouldn't vote on this before Christmas. Let's see if she holds to that word. Bottom line, this thing is still very fluid. Keep a watch, keep for what we're doing here at Eide Bailey. And that's it. I think that's all of it.
Stay tuned, everyone. Yeah. And we will obviously keep, as this progresses, we will make sure that additional information, both in written form and I think another webcast, as we get more certainty, we will make sure that that is available to you. And I want to thank you for attending here. Jay needs to speak up.
Yes, I forgot to say this. Senator Manchin might be releasing his tax proposal. Whatever is being released today, if it's released today, will be changed according to Senator Wyden. So whatever you see saying Wyden has released a tax bill, that bill will be changed by next week.
So stay tuned. And again, thank you for joining us, giving us a couple of extra minutes here. And we look forward to talking with you when we know more. Take care, everyone.